future. We're talking real money.
Well, we're back. You just can't get rid of us. It's like a bad penny. I don't even get that saying, the bad penny.
Turns up again.
What is wrong with a bad penny? Who cares if it's a penny?
In pennies today? I think it'd be more like a bad $20 bill.
Yeah, it's not worth anything.
Yeah, no, it's not. Sorry.
We're here to talk about pennies, though. Lots of pennies. We hope hundreds of thousands or millions and millions of pennies, and how you deal with your pennies. Not JC. No, sir.
Nobody knows that reference either.
It is Christmas.
So keep going. Yeah.
Oh, wait, wrong JC.
Bad penny, JC Penny. You keep bringing up things that nobody else is going to know.
I'm feeling a little old because I used to work for JC Penny.
Yeah.
I did. I sold TVs. And get this, VCRs.
Do you miss it? Did you wish you stuck with that? Would that have been a better career path for you? That okay?
Yeah,
come
VCR
home with your little
sales?
Sears shirt on. Hi, or no, JC Penney shirt. Pardon me. Yeah.
No. We wore suits and ties.
Oh, of course.
We were salesmen and women. Okay. And oh my gosh, was it a brutal business, because you'd have, like, on any given shift, you'd have 3 to 4 salespeople on the floor, and if if they're in the aisle, you don't touch them. But the minute their foot hits the carpet, then they're fair game. And everybody is like trying to push their way to the front to get the client, particularly if they walk in and they make a beeline for a 25-inch console television.
Oh, big
because
money.
25-inch console television, those things went for like $1,000
back in the day. You're really showing your age now.
I know. And then we had to wrangle the thing out into the truck, and oh my goodness, that's why I hurt myself. Hello, everyone. Welcome to Talking Real Money. Not talking real television sales, not talking real retail, not talking real pennies, but talking real money. I am Don McDonald. I'm hanging out here. Tom is hanging out over there. And you are wherever the heck you are when you listen to a podcast. And it could be anywhere. Today, we want to talk about you youngins out there. Now, a few years ago, we probably wouldn't have done this topic, but lately we have a lot of younger listeners, and that's really heartening because it makes me feel very, very good about your future, you in your 30s and 40s, who, by the way, you may feel old, but trust us, you're not.
Yeah, and it applies to more than just those persons. I got kids in their 30s. Late 30s even. And so
me too.
Because these are young people in your life, perhaps, that you should be helping. You should talk to them about these things, difficult topics many times, but making sure they're on the right path for retirement. And when you're 30 years old, you're like, that's never going to happen.
Oh, and again, that's so far away, but
trust
guess
me,
what? It isn't.
Will. Yeah, I know.
It isn't.
I know. Hard to believe. So I love this piece. 3 things to do in your 30s to stay on track with retirement savings.
Who's this from?
Take a guess.
Bloomberg.
No. CNBC.
See, usually you bring stuff from Bloomberg.
I know. I love Bloomberg. So, and I love this quote from a certified financial planner. So the 30s can sometimes be more stressful because your responsibilities have gone up. Boy, was that true in my life. Mm-hmm. And you're still not earning your potential of your 40s and 50s. And that was true for me too. I made a lot more money in my 40s, 50s, and frankly 60s than I did in my 30s.
When you're raising babies.
Yeah, exactly. When you could have used that money more. But I like this article, and I got a few suggestions of my own for people, younger people, our children, not our grandchildren yet, in their 30s. And here's their first suggestion, which I think makes sense for anybody, by the way. The age is not important. That is revisiting your retirement accounts. Looking at whether you're putting money away in a traditional, a pre-tax type arrangement, right? Whether it's a 401k IRA or Roth. And I think this is something that's way overlooked. And oftentimes people make this selection and then they never look at it again. And you should be reviewing it. You should be reviewing it in terms of your taxation. You should be reviewing it in terms of, I think, balance between the two. Because I think when you retire, it'd be better to have some of each.
Yeah, sort of an annual look back at the at the year, at what you were doing, at why you were doing it, at rebalancing, moving things around, and reconsidering your reconsidering, re-examining your goals to see if anything has changed, if your needs might have changed, or your risk tolerance, or your family situation where you may have to do something a little differently.
We'll get to more of that in just a moment, but eligibility for a Roth IRA phases out for individuals with an adjusted gross income of $138,000 a year. And if you're a couple, I think it's somewhere around $200,000. So if you're making more than that, then you need to perhaps look into a thing called a Roth, a backdoor Roth IRA, or most employer-sponsored plans now have the Roth option. I would be re-examining the Roth versus the traditional and your asset allocation. Don correctly points out.
Yeah, but the question still comes up, though, when we get a lot of calls. Which is better for me?
And we don't know that. We're not going to know that for another 25 years.
So how do you re-examine it?
That's why I like both. Better? I like both.
So you're saying just have both?
I think you should split the baby on this one because you just don't know where you're going to be in 30 years. It's a long way off. And having some of each, and actually having some of each plus a taxable account makes a ton of sense when you're going to take that money out, because then you can game it as to the taxation of each one when you're in the withdrawal stage. I think it makes total sense. Number two, according to CNBC, figuring out, you just mentioned this, how new big goals fit in. We're talking about, I hope we're not talking about wedding. They mentioned wedding in there. You know, I'm not a fan of big weddings, big expensive weddings, because I think
I think they're utter wastes of money.
Having children,
a house,
whole different thing. Yeah, I think having a child, fantastic, or becoming a homeowner. I mean, which is now far more expensive than it was just 2 years ago. And as you know, we've talked about.
There was just a recent piece in the Wall Street Journal again, a chart that showed it was renting. That was about an average of $3,000 a month, and buying was about $3,000 a month, and renting was about $2,000.
I know it's just hard to tell people. Wait, I guess. I mean, our prices coming down, our interest rates coming down. We don't know the answer to any of those things. And as you know, we've stated many times. In fact, we just had one of our raving fans in here yesterday and said, Don will say, it depends. I'll say, you're right. It depends. There's a lot of, because it's a lifestyle decision.
Or, you could just make the Airstream and a dog decision. It's so much cheaper.
I see you on that road with that Airstream.
The Airstream with the dog.
I'm still waiting, by the way, for the second paving bid, which should come along any day now.
I can't believe you're doing this.
Yeah, I'm paving it up, man.
He's paving a space next to his house so that I can park my Airstream. And it'll be in the summer, so he'll have the above-ground pool set up in the backyard.
Wait, I didn't tell you really why I'm paving. The reality is I don't want them to find my mother-in-law. So once the paving,
if you pave over, it's less likely they'll look.
Way harder.
Yeah,
way harder.
It is. It's harder.
Anyway.
The dog stopped sniffing around.
What the hell was that? Yeah, never mind. Okay.
We are just awful. We are horrible human beings.
True. And the thing is, I tell her this, and she thinks it's funny, so it's okay. Number three. Or maybe she can't hear anymore. I'm not sure which it is. I'm sorry. This is very important, actually.
She doesn't listen.
No, she probably doesn't even know I do a podcast or a radio show. This is very important. This really is. Well, there's only two people in my whole family, I think, that know. Very important. Keep an eye on lifestyle creep. I mean, I think this should be number one. Not that creep. Not that. Well, I guess I'm not one in my family.
Watch out for that creep in your lifestyle.
Exactly. We got those people.
Oh, look.
But you see this all the time. In fact, just met with a very nice person this week who is in commission sales, who had I don't even want to say the amount, income about doubled 1 year, a couple years ago. I mean, and this person was already making a good living, but it doubled. And I said, oh, great. Where did that money end up? Guess where it ended up? Buying things. It didn't end up being saved.
Stuff.
Because you've talked about this before. Sometimes you have to adjust your lifestyle down when you have less money. But people also have a tendency to say, well, I'm making a lot of money now. I can go buy this. I can do this. I can stay here. I can fly this way. That's what we're talking about. And so having a look, I think, at the end of every year, especially at the non-essential expenses, which I don't know what those include because there's a lot of those in my house.
Well, it's like, you went to Hawaii. I went on a cruise.
That's a good point. Those are, wait, that's non-essential? Okay.
Yeah, we did do some,
I know.
we didn't
I didn't. I
always
just said I
follow our
suffer
own
from it
advice.
too. I suffer from it too. And when I get mad about money, I tell my wife, this isn't just you, because I'd make these decisions right alongside you. There's no
Although
question.
I have to give you credit, you bought a Toyota, not a Lexus.
I was going to have the
you were
Rivian,
gonna get
which
the
would have
Rivian.
been 20% more.
I bought
So
a
I saved
Honda,
lot.
not an Acura.
I'm not a car guy.
When
It
we get a
plugs in,
tow
I drive home.
vehicle, when we get a
That
tow
car has been
vehicle,
awesome
it'll
because,
be your
as you know,
Nissan.
I plug it in when I go home at night. I drive to work the next day. I drive home. I plug it in again, and I filled up the tank for the first time in 5 weeks the other day.
Wow.
So I just love that. It's just
Wow.
not going to happen.
Particularly what gas costs in the Pacific Northwest.
Yeah, it's still like $9 a gallon.
I just looked at yesterday at the gas station near my house, and 2 days ago it was $2.95 a gallon, and yesterday it was $2.75 a gallon.
Wow, wait till tomorrow. No, I can't.
It's going in the right direction for me.
All right, just back to the three. Revisiting your retirement accounts. Total, I think for every person who's making a contribution, that is very important. Keeping an eye on that lifestyle creep, because he might be in your neighborhood. I haven't seen him, but you never know when it might show up. I think we should just leave it there. I love that one. No, I'm kidding. There was a second
one. You had some
one.
more, you said.
I know. I have some of my own, actually, that I think anybody, by the way, figuring out the new big goals. That was the third one. Here are my three. Okay. And I think these are very basic, and I think everybody should do them. Number one, and this is so easy, but it happens because of various things. Don't take on expensive debt. We run into a lot of people that are saving in their retirement accounts, but they're also piling up credit card debt, which is now on an average of like 22% or something. It's ridiculous.
Oh, it's outrageous.
So it's best to pay that down, because I don't know of an investment that pays you 22%. I don't know of one. I've been doing this for a while.
There are plenty that, there's some that probably claim that.
Yeah,
but
there
lying.
are. Yeah.
Okay,
number two, for me, so even if you had expensive debt, I would still be saving, and I think every person has to save at least up to getting the free money in your employer-sponsored plan. You just have to do it.
Oh, yeah, I do that. I want their money. It's
exactly.
free.
It's free. Here's the other mistake I see for people in their 30s. They don't have the right asset allocation. I see a lot of people that have it all in, what's I'm forgetting that, not the short-term bond fund, but the other one that's the insurance products, the GICs that are paying the guaranteed interest.
Yeah.
3% or whatever it is. I see a lot of that. I see a lot of people that have it in one asset.
Stable value funds.
Stable value, thank you, that have a lot in one type of assets, like U.S. large cap, for example, S&P 500 mostly.
That problem isn't limited to just our 30-year-old listeners. That's pretty much everybody.
No, it is.
It is so rare for us to see. It is so rare for us to see a portfolio that is properly invested, properly diversified, and for which there is some semblance of a plan.
Couldn't agree more.
We just don't see it, and it's probably the most important thing that you can do.
It is. It's more important than the stocks you pick.
Oh, yeah.
Because being in the right asset classes have been so. But having that, you're right, Don, the right asset allocation, but being aggressive. In your 30s, you should be mostly in stocks. Maybe uncomfortable from time to time, but remember, the day when you're going to pull that money out is a long way off. You want a lot of growth, and the way to get that growth is to be more stock heavy, less bond heavy. That at least is what history has showed us. I think those are three pretty easy ones for people in their 30s.
I think it was all pretty easy. It's just basically common sense. You save more, you have more.
They don't need us anymore
less,
then?
You make more. No, that's
okay.
what I've been saying about our podcast for years.
Is
that if everybody listened to what we said and did what we suggest and didn't vary from it, then they wouldn't need us. Good news is, nobody's doing that. Very few.
Keep it down.
So, we enjoy getting your questions too. We love to hear from you, and you can do it a variety of ways. You can call us on our Saturday show live at 855-935-TALK, or you can call that number and leave a question on the voicemail thing. But one of the coolest ways to ask a question is to go to talkingrealmoney.com, because you can do two things there. You can either record your question with the mic on your computer or your phone, or you can type it in, and the typed ones go on these podcasts and get read to us by Tom.
We get a lot of great questions. This one comes from Rob in Seattle. He says, I want to rebalance my $200,000 in the FXAIX fund. That is the Fidelity S&P 500. I want to leave 50% of my money in that fund, but put the remaining 50% in the Vanguard Total Bond. Of the 50%, 20% in the Vanguard Total Bond, the international fund at 10%, and then the 30 individual value S&P 500 stocks with good dividend yields, 20% there. Here's the question. I'm having trouble pulling the trigger on the rebalancing. I fear leaving. I keep leaving the $200,000 in the FXAIX. Is this a normal feeling wherein the ease of doing nothing outweighs the fear of making a mistake, or is my fear actually a voice of reason? Welcome your thoughts. Any words of wisdom to me that I may be overlooking? I've got a couple, but what do you say?
It's 100% normal. We doubt every decision until we make it. And then we've made it, and then we figure out a way to make the best of it once we have. We can't know the future. We can't. But we think we can. We think that somebody can. We think we'll know when it's the right time to do something. But the reality is you will never know when it's the right time. The right time to do the right thing is right now. Ooh, I'm going to put that on a mug.
Always the right time to do the right thing.
No, the right time to do the right thing is right now.
That's pretty good. That's pretty good.
If
I could add another suggestion here, Rob, I don't like your portfolio very much.
No.
I was just going to say. So here'd be my alternative to what you just said. I would own the FSKAX. That's the total U.S. I would own the F with a third of the money. I would put a third in the FTIHX. That's the international all stock market.
Yeah.
And then the FXNAX was the bond. One third. It's easy. It's simple. You could rebalance it every year if you needed to. I think it's way better because basically what you have is 70% in the S&P 500, 10 international, and then some in the bond. I don't think that's a very well-balanced portfolio. Sorry.
No, it's a wacky portfolio. In the individual stocks and
not liking it.
I mean, I love the value tilt. And is this at work or is this? Did it say?
It didn't say. I read you the question in its entirety, my friend.
If this is in a brokerage account, I would change Tom's recommendation completely.
You'd use ETFs.
I would use either the Avantis or the DFA total market ETFs.
Yeah.
Because they both have a value in small tilt. And then I would use BND for the BNDs.
There you go, for the bond. Yeah, okay.
Yeah.
Fair enough.
And the nice thing about it,
I don't disagree with you there.
If it's a taxable portfolio, you're going to get a tax advantage. As a matter of fact, on a future podcast, we're going to talk a little bit about a tax advantage, another little tax advantage that can come from owning ETFs. ETFs, got to tell you, ETFs are turning out to be a flippin' brilliant product.
They're going to rule the world, investing world at least. Okay, from Jeff. Just love the podcast. I did an assessment on my portfolio with Sean a week ago. He provided very good advice. Thanks, Sean, for the review. Sean is one of our advisors that you always talk about, Don.
And he didn't try and sell anything?
He didn't try and sell anything. And by the way, Sean, congratulations to him. Completed his CFP designation recently, too. So well
That's
done.
hard.
Yeah, it's really hard.
Getting a CFP is hard. I've never gotten it. I've read the materials and I went, I don't think I need it to be a talk show host.
Pretty good. He says he's retired with no debt. Portfolio review showed I was in line with recommendations. I currently have 20% in CD ladders. These funds are used for living expenses. For the long term, which is better, a bond fund or a CD ladder for a core position?
Oh, we have an ongoing debate about this.
We do.
It's a quibble with very, very, very little difference in reality. The likely difference is more psychological than financial, because with a ladder,
I'll say operative too, by the way.
Huh?
Because you got to, with the CD ladder,
right.
you got to do it.
I agree. More
bond
work.
fund. Here's my
More
money.
work.
See ya. Yeah.
The bond fund, easy breezy. You just put your money in. You let them do the laddering and the rebalancing and all of that. When you do your own CD ladder, it does require a level of discipline that most people don't have. You got to remember, when that 1 year CD comes due, you must immediately invest it, because if you don't, then you're becoming a market timer. Then you destroy the ladder. The ladder has to be structured. But the nice thing about the ladder, you don't really deal with volatility. And there's no risk. So you always, if you're going to hold them to maturity, and that's part of the discipline, you're never going to sell them before they mature. And if you hold everyone to maturity, then there is pretty close to literally zero chance of losing money.
And I can tell you exactly what's going to happen here in, I'll say, 2 years. Rates are going to go down. And then people are going to say, I don't want to be in a CD because the rates are only 3.5%.
Right. I don't want to take my 1 year CD.
Guarantee it.
I don't want to take my 1 year CD out to 3%. Yeah. Because my other ones are paying 5%.
Yeah. And then I'll just move it into bond fund and we can say fairly unequivocally that looking back over the long haul, bond funds have made more money than CDs.
Yeah, because there's you
got to accept some volatility.
But when you take out the capital gain portion
that's true. Yep.
The reason the bond fund returns have looked so good is because we had decades of falling rates,
which we could have decades again. Could have it again.
My belief is that, all things being equal, the average income return, which is really all you should ever count on, is going to be almost identical, because they're dealing with very similarly yielding paper. A treasury yields very similarly to a CD.
With less work.
I agree on the less work.
And again, as you said, not only the work, will it get done?
It's right. You got to do it.
It has to be
100%. You got to do it.
Just like the guy who didn't want to pull the trigger on his portfolio.
Right. And it's hard to do.
It is.
And that's the psychological hurdles we have to overcome. And we're not very good at that.
No, we're not. Be honest.
But you are good at listening. I just got a report from Spotify that said our downloads for 2023 rose by about 75% from 2022.
Wow.
I
thought at Spotify was just basically people listening to music. I didn't even know that many people.
No, they got a whole podcast. They're big in podcasting. They're number 2 to Apple in podcasting.
Wow. Okay.
Although Apple, we get like 50% of our listeners from Apple and 7% from Spotify.
So if you're on Spotify, tell your friends to listen on Spotify. Tune in. Might help us. Yeah.
We need that, and it does skew a little younger, I think, the demographic. So, anyway, we're glad you listened. Thanks for being there. Please tell your friends over the holidays to listen to the podcast when they're sick and tired of gorging on candy and opening presents and watching football games. It's something different to do. And it's educational, too. And if you want to get in touch with us, go to talkingrealmoney.com. And anything else you want to add?
Nope, I don't. Happy holidays. Thanks for listening.
We're talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.